These are the major time frames that 99% of forex traders use. And one of the best ways to minimize market noise is knowing your time frames. What is market noise? Market noise is simply all the price data that distorts the picture of the underlying trend. That is to say, the trend currently going on. And this is mostly due to small price correction as well as volatility. And we can minimize this noise by scaling to higher time frame instead of trading from smaller time frames. We will be using New Zealand US dollar currency pair throughout this video. This is a 5-minute chart. Looking at this chart, we can see it has too many little price movement. The 5-minute chart has too many candlestick bars, thereby making it hard to know the main trend. Is our trend bullish or bearish? This question will be hard to answer using the 5-minute chart. Now, if we go back to the 4-hour chart, we will see the market noise in the 4-hour chart is not as much as the 5-minute chart. Smaller time frames tend to have too much noise, and many traders get lost trading in smaller time frames because they do not understand that the big trend in the larger time frame is the one that actually drives what happens in the smaller time frames. Having said that, I do trade in smaller time frames by using trading setups that happen in larger time frames. I will show you how I do this later on. I do this to get in at a better price point and keep my stop loss tight. This is called multi-time frame analysis. You should know that one candlestick in the 1-hour time frame is equal to 2 candlesticks in the 30-minute time frame. If I highlight one candlestick in the 1-hour chart, you will see 2 candlesticks in the 30-minute chart. So the higher the time frame, the lesser the candlestick you will see. Looking at this pair, New Zealand US dollar, we will now go back to the daily time frame to see the current trend. We have ourselves a bearish trend line and a small bullish trend line. Having drawn our trend lines and support zone, we have a support zone here. We will now scale to the 4-hour chart to get a clear view of price movement, or better still, go to the 1-hour time frame for our entry. Here is the small trend we drew on our daily chart. Price respected that zone a couple of times. A lot of traders actually flock to low time frames, and this kind of system have two major problems. The first is that this low time frame picks up the intraday noise of the market, making it hard to get a clean read on the charts and do accurate technical analysis. The second is that price action trading is hard to follow up with lower time frames. I don't take trading decisions based on price action of a chart less than 15 minutes. That is why we drew our trend lines and support zone on the daily time frame before scaling down to lower time frame. The 1-hour chart is good, and the 4-hour chart is more meaningful, and the daily chart is even better. So we have another bullish trend line here on the 1-hour time frame. Now, two reasons why I use multi-time frame analysis. The first, I get better trade setup, and the second, I reduce stop loss distance. Let's say I'm looking to buy New Zealand US dollar because of this trend line and price broke this resistance. If I enter the market using the daily time frame, my stop loss will be huge, and the issue with this is that my risk reward ratio can be reduced. If I draw my long position tool, here is the long position tool. If I draw it here, and if I should go back to the 1-hour chart, I'll see that the distance from my entry and stop loss is huge. I'll now remove this tool. Even though I am trading with a setup in the daily time frame, what I'll do is go to a smaller time frame and watch out for a buy signal. If I have one, I will enter the market and input my stop loss. If I should draw our long position tool, we will see that our stop loss is small. As you can see, my stop loss is outside the bullish support level. So when we trade in the smaller time frame, we can actually trade a lot more contracts without risking more, because our stop loss distance is very small compared to the larger time frame. These simple examples explains why I wait patiently for trade setups to happen in the higher time frames and then use smaller time frames to get good trade entries. That is the beauty of multi-time frame analysis using price action. Now here is the thing about larger time frames. They cover up trading setups that are happening in smaller time frames that could really be reliable trading setups.